FOMC Day, the liquidity pivot that ignites the next market, crypto, and labor regime. Today's FOMC is not just another rate decision. It is the potential formal confirmation of something markets have been front-running for months. The end of restrictive policy, the return of balance sheet expansion, the transition from Fed-dominated macro control to Treasury-driven capital direction, and the ignition of the next speculative, productive, and labor expansion cycle. This decision is not just about stocks. It directly determines the trajectory of BTC and ETH, the re-leveraging of global liquidity via the carry trade, the revival of risk appetite, and ultimately, the structure of the job market for the next decade. The two FOMC outcomes that matter today. All outcomes collapse into two functional paths under the Federal Reserve. Scenario 1. 25 basis points cut. Controlled easing. Market interpretation. The Fed is easing, but still attempting to preserve credibility and inflation optics. Immediate effects. Financial conditions loosen modestly. Risk assets rally, but selectively. Mega-cap tech leads, small caps lag. USD softens mildly. Carry trade remains partially restrained. Crypto impact BTC grinds higher. ETH lags initially. Volatility remains controlled. This scenario supports a bullish continuation, but not the reflexive blow-off phase. Scenario 2. 50 basis points cut. Policy admission event. Market interpretation. Something in the financial system required immediate liquidity override. This is not stimulus. This is loss of tightening control. Immediate effects. Financial conditions collapse looser. The front end reprices the entire 2025 rate path. The USD weakens sharply. The yen weakens aggressively. The global carry trade releverages violently. Small caps and cyclicals explode higher. Crypto impact spot BTC absorbs institutional inflows. ETH beta expands aggressively. Options dealers forced into reflexive delta hedging. Volatility rises with price, not against it. This scenario activates the Santa rally ignition phase into January. QT is already over. The market is trading early. QE. QT officially ended on December 1st. Since then, repo stress has eased. Dealer balance sheets have quietly expanded. Treasury issuance has been absorbed without yield spikes. Whether or not the Fed uses the words, the market is already trading a stealth return of balance sheet expansion. An announced $35 to $50 billion expansion today would simply make official what liquidity already knows. Why January becomes the reflexive melt-up window. Multiple forces now converge. Releveraging of the carry trade. Residual record BTC and ETH short interest. Dealer negative gamma exposure. ETF-driven spot absorption. Regulatory clarity narratives unlocking sidelined capital. Potential sovereign front-running behavior. This is the setup for forced short covering plus gamma hedging equals nonlinear price expansion. Moves measured in hours, not weeks. Thousands, not hundreds. BTC and ETH, the liquidity expression of the regime shift. Bitcoin, BTC. Expected to challenge and break prior all-time highs in January. Likely euphoric peak mid to late January. Expected 25 to 35% corrective reset into February. 2026 projection band, $170,000 to $240,000. BTC is transitioning from speculative hedge, sovereign balance sheet asset. Ethereum, ETH. Conservative base case, $7,000 to $12,000, with institutional staking approval, stablecoin settlement dominance, tokenized treasury and equity settlement. Upside scenario, $20,000 plus. ETH becomes the financial infrastructure layer of the new system. This is not a Fed-driven economy anymore. The structural macro shift underway is simple. Monetary policy is losing dominance. Fiscal and capital direction now rule. The center of gravity moves toward the U.S. Department of the Treasury. That means capital flows become politically and industrially directed. Strategic sectors receive permanent funding bias. Labor demand becomes a downstream function of Treasury priorities. This is why AI, compute, energy, infrastructure, BTC, ETH, and manufacturing sit at the core of this market cycle. From the market melt-up to the new labor regime. The coming market expansion does not create a jobless future. It creates a machine-levered labor renaissance with extreme sector dispersion. Wages will rise, but selectively. As the cost of money falls, debt gets refinanced, margins expand from AI efficiency, equity values rise, Treasury capital flows accelerate, hiring velocity will increase. That produces real wage growth. Margin-driven hiring. Checkmark productivity-driven compensation. Not uniform wage growth. White collar does not collapse, it stratifies. What shrinks admin layers, middle management, credential-only desk jobs, redundant paper-pushing roles. What expands AI engineers, automation specialists, data infrastructure operators, security engineers, on-chain financial engineers, systems architects. The labor market becomes barbelled. Elite technical operators at the top, exploding blue-collar labor at the base, a shrinking credential middle. The death of the degree as an economic gate. Hiring now shifts to certification, proof of work, skill testing, immediate deployment. Already dominant in software, AI, cybersecurity, on-chain systems, automation. The economic result is unavoidable. The college industrial complex enters structural decline. Advanced degrees remain for medicine, law, architecture, hard engineering, regulated sciences. Everything else shifts to market-verified skill. The blue-collar and vocational supercycle, the biggest winner. The largest employment and wage expansion of the next decade will occur in electricians, linemen, welders, plumbers, pipe fitters, HVAC, heavy machinery, crane operators, data center construction, semiconductor fabs, grid build-outs, logistics, housing construction and renovation. These jobs are capital-intensive, location-specific, physically contextual, extremely difficult to automate. AI-assisted, not AI replaced. At the exact moment AI explodes demand for compute, power, energy, infrastructure, manufacturing, housing, you get the largest blue-collar labor shortage in modern U.S. history, which drives wage bidding wars, overtime surges, union and non-union pay resets, trade school booms, paid apprenticeships, guaranteed regional job security. This is structural and decade-long. The AI productivity arrow margin arrow hiring flywheel. AI slashes unit labor costs. Output per worker explodes, margins expand, capital reinvests, hiring accelerates, wages rise for high-signal labor, low-signal roles vanish, economic output resets permanently higher. This is nonlinear growth powered by machine leverage. Why labor data will look wrong the entire way up. Headline data will show white-collar layoffs, uneven participation, soft hiring optics, while beneath the surface, trade wages surge, infrastructure zones boom, data center corridors industrialize, energy labor shortages worsen. The economy will look confused on paper while actually being replatformed from the inside out. Final synthesis. Today's FOMC is not just a rate decision. It is the potential ignition point for a renewed liquidity regime, a BTC and ETH expansion phase, a Treasury-directed capital supercycle, a structural shift in how jobs are created, the collapse of credential gatekeeping, and the largest blue-collar wage expansion in generations. The one-line macro thesis. We are exiting a Fed-dominated post-COVID distortion cycle and entering a Treasury-directed, AI-amplified, BTC, ETH-settled economic expansion with rising asset prices, rising wages, collapsing credentials, and a historic blue-collar labor supercycle.